Hello, everyone. Welcome to this episode of Expert Speaks. Between 2020 to 2024, markets were making news every day. Everybody wanted to participate in the market. You will be left behind if you don't put your money into the stock market. Everything of it. 24 is gone. 25 is showing no signs of market revival and it has not crossed the previous peaks. Now it's a time people hate the market. They don't want to remain in the market. The behavior of everything putting into the market or exiting the market 100% out of it. Is it the right behavior to follow? What are the pitfalls of it? What should be the ideal approach an investor should follow to make most out of the stock market investment? I'm going to ask these questions to a very experienced person who has spent closer to 2 decades in the stock markets, and he will give you the right answers. The expert of the week today is Mr. Manoj Jain of Value Metrics. This is NRI Money Clinic for you, and I am Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Are you an NRI living outside of India for more than 10 years? Have you dreamt of a retired life in India in a beautiful house and a lifestyle of your choice? Your dream can come true only when you take some simple and effective actions today. I will take you through a step by step process to make this dream come true in my webinar Stress Free Retired Life in India. Hello, I am Dr. Chandrakant Bhatt, financial guide and founder of YouTube channel NRI Money Clinic. I have to my credit creating secured retired life for thousands of NRIs spread across more than 60 countries. If you have an intention to make your dream retirement come true, register for my webinar. More details are in the link below. Dear viewers, to talk about the behavioral aspects and the dynamics of the market and the investors' behavior, how it should be focused to make money out of the stock market, we have amidst us today a very eminent guest speaker, Mr. Manoj Jain. Mr. Manoj Jain is co-founder of Value Metrics Technologies. It's a valuation-based analytical platform meant for B2B business. Mr. Manoj Jain comes with a rich experience of close to 2 decades. He worked in mutual fund industry with companies like ICICI Prudential Mutual Fund and White Oak Mutual Fund. Before he started his journey with Value Metrics, his last assignment was head of products at White Oak Asset Management Company. Welcome to this episode, Manoj Jain ji. It's a great to have you, and I will look forward to conversing with you with your rich experience of what investors must do and what they should not do. Are we ready to get started?
Yes, sir. Thank you so much, Chandrakant ji, first of all, for inviting me and for your kind words.
Manoj ji, when the markets are doing well, everybody wants to be in the market. They will look into the nook and corners of the cupboard and want to bring everything and put it into the stock market. A few months of lackluster performance from the market, they hate the market. They don't want to be here. They want to chase gold. They just want to chase the land. They want to go back and say that no, stock market is not for me. It's only FD which works. Everything in it or everything out of it. How do you react to this behavior of individual investors?
So let me start the conversation with a very famous ghazal was sung by legendary singer Mr. Jagjit Singh. The ghazal is like this, that दिल भी जिद पे अड़ा है किसी बच्चे की तरह या तो सब कुछ इसे चाहिए या कुछ भी नहीं. Basically, it tries to convey the message that in this verse, what the writer does, he has compared the emotional intensity of the heart with the stubborn innocence of a child. Like when a child wants something, so he or she will put all the tantrum to get that thing. So they want everything or nothing. There is no half measure. Likewise, similar pattern we have seen with many of the investors, and including myself also during my early years of investing, that when we have some positive view on one particular asset class, on one particular theme, or maybe on one particular stock, we want to grab everything out of it. We want to put everything into that particular theme. If we are so convinced that equity is about to do well, why to invest only 50% of it? Why not invest everything into equity? Or maybe if we believe that EV will do well, or maybe we believe that solar power will do well, defense will do well. So it is obvious for any investor to think in a way that why not put everything into it and get maximum out of it. So this strategy is called all or nothing. Either you are investing everything or you believe that markets are going to go down. So why should I invest even 50 rupees in equity, like what we have seen during COVID time, during June, July, August, or let's say April, May, June, July, August of 2020, when many people believe, including many of us also, it is not that only few people were of the opinion that COVID is going to stay. It was a common perception. This was a common belief that COVID is going to stay for a very longer period of time, and hence equity may not do well. In that situation, many investors redeem everything from equity mutual funds or maybe from stock market. All and nothing strategy. Either I will be 100% invested in equity if I believe it will do well, or I will redeem everything from this volatile asset class if I believe that it is not going to perform well. May not be the best strategy when it comes to equity investment. It looks very good when it comes to desiring anything, when it comes to love, etc. Like we have heard in this ghazal, but when it comes to serious business like investing, all and nothing is not the best strategy. In fact, if I have to put my opinion, I think this is one of the worst thing an investor can do.
I understand this thought process very well because I have stayed in the market for a long period of time. It has happened in my life, and I have realized it over a period of time how it's essential to stay the course of the market. Markets will reward people in a selective way at selective periods of time. So there is no choice for people to choose a particular timing. Can you take with a few examples how this extreme behavior of investors, either to be 100% into it or 100% out of it, may hurt the investors in the final run? What instances you have to quote, or what statistics you have to quote, or what examples you have to quote?
See, the investment should be made in such a manner that during extreme market scenario, so there will be extreme scenarios, by the way. Markets are very complex. The world around us is very complex. There can be hundreds of things which we cannot predict. We cannot be 100% sure at any point of time. Even today, yesterday, tomorrow, we cannot be 100% sure because we cannot create a model or a framework by which we can know with 100% precision that what is going to happen tomorrow, which means we have to think in probabilities, which also means that we have to create a portfolio which doesn't trigger emotional outburst during extreme market scenarios. So, for example, every 10 years, we have seen something or the other happening which we cannot predict before that particular event taking place. For example, recently it was COVID. Before that, last decade, it was global financial crisis. We could not predict that a bank of such a large scale in a country which is regarded one of the safest country in terms of financial investment can go bust. Before that, it was tech bubble in the year 2000. Before that, it was some scam. Let's say when it comes to Indian equity market perspective, it is called Harshad Mehta scam, for example. So all these things we cannot predict. And all these things, because of the intensity of these events where markets were down by 30, 40, 50% sometimes, will trigger emotional outbursts. So our investment strategy should be such that under no circumstances we start thinking emotionally and we forget our discipline approach of investing. So the only solution to this problem, that we should avoid taking decision emotionally, is to avoid certain instances which trigger emotion, which is by diversification. So even if you believe that equity market should do well, I think it is prudent to not to invest all of your money in one single asset class or one single theme. And even if you believe that markets are going to be lackluster for some period of time, it is prudent to stay invested with some amount of equity or some amount of your investment in equity as an asset class via mutual fund or maybe via some other route, because you never know what will happen next and equity markets start doing well. And in that situation, because you are not invested in equity, you will be left with a feeling of regret. And more often than not, we have seen that this feeling of losing out on potential gain will trigger emotional outbursts, and people tend to invest larger amount at a wrong valuation. So to sum up in one single sentence, I think investment should be made in such a manner, portfolio should be created in such a manner that we can avoid taking emotional decision. And that can happen only via diversification.
See, problem lies in the fact that people come with a specific outcome of their investment. For example, stock market will give you 18% return, 14% return, 20% return. It is as if like a fixed deposit that they get from the bank. They come with a picture that itna hi milega, right? Agar 14 mil gaya, wo galat hai, right? So people come with a very deterministic kind of a mindset. Is it a good idea to replace the word with a deterministic approach to investing? How do we use the word probabilistic, okay, if everything is well, this could be the outcome. If things did not happen the way I expect, then this should be the bare minimal expectation that we should have. Benchmarking should not be just for a Nifty or a Sensex or whatever it is. Benchmarking should also be done with respect to what is acceptable to me. In the worst circumstances, I have FD as my benchmark. Kuch bhi ho jaye. I should not get something lesser than an FD, because if I don't invest in this asset class, markets, wherever it is, I would have kept the money in a fixed deposit. So if the events did not pan out as I want, at least I should not lose what I would have got from FD. So that takes to the topic from being deterministic in our approach to a probabilistic in approach. How do you think this approach will be useful to the investors, or is there any other way you profess this?
See, basically, betting on a single outcome is essentially saying that I am 100% sure that this will happen. But in reality, as I said, because there are too many moving parts, like the kind of confusion we are seeing from last 1 week, nobody was anticipating. Okay, today our Prime Minister met China's Prime Minister, and 1 week back, nobody can even think about this situation that both these gentlemen will be shaking their hands. So you cannot be 100% sure. And when you are betting on one single outcome now, you are saying that you are 100% sure, which is the wrong way of thinking, in my opinion. We should think in a range of outcomes, whereby this concept of thinking probability comes into picture. That I'm 80% sure. With the moment you shift your mindset from a 100% deterministic mindset to probabilistic mindset, you tend to take better decision. And over the long term, you can stay invested. And we know over the long term, equity is one of the finest asset class, can generate a lot of wealth. Second thing, anything which is not volatile. For example, in 10-year government of India bond, returns are almost guaranteed by government of India. So they are guaranteed return. Over the 10 years, you will get, let's say, 6% return or 6.5% return, depending on what is the rate right now. Because the returns are guaranteed by government of India, you get only 6.5%. Equity can deliver 12% over the last 40 years or history. Equity market, let's say Sensex has delivered more than 15% CAGR. Although I must add this disclaimer that past performance may or may not sustain in future, but this is the realistic data. This is the factual data that yes, equity has delivered 15-16% CAGR return as well. And some mutual funds, which are operating from last 20 years, 25 years, have generated even higher return. But the moment you want certain asset class to give predictable return, these high return from that particular asset class. The very reason a certain asset class is having this potential to generate higher return is the fact that it is a volatile asset class, and hence it is compensating investor to take risk. The moment you remove risk from an asset class, you will get risk-free return. So today, the risk-free returns are hovering between 6.5%. So two things. First of all, if you are investing in equity, obviously you would expect returns to be on the higher side over the long term. But returns cannot be in linear line. It cannot be that every year you are getting 12%, every year you are getting 14%. If you stay invested over the market cycle, you will get very decent return. Like we mentioned many a times that over the long term, returns from equity market will mimic the nominal GDP growth or the earning growth of companies you are investing in. So, which is very healthy number. But every year you cannot expect that the equity market will deliver 12% or 15% return, because then it will become safe. There will be no volatility. And if there is no volatility, why would you get 15%? You are getting 15% or for 12% for taking risk. If you remove the risk, you will get risk return, which is 6% or 6.5%. So yes, to sum up, I think when investing in equity, because it is impacted by so many events, which we cannot predict with 100% accuracy. Nobody can predict with 100% accuracy. So it makes a lot of sense to think in probability. If you are sure that there is 80-90% probability equity will do well, you can be overweight in equity. And if you are, let's say, sure that the circumstances and the situation around the world is such, or the economic cycle is such, that equity market may not do well over the next 1 or 2 years, maybe you can be underweight. But again, I would strongly suggest don't take extreme steps of investing everything or nothing.
Right. So when you say don't invest in an extreme step manner over committing to any specific asset class, that takes the discussion to another topic, which is called the position sizing, which is quite common for a fund manager or anybody who is knowledgeable in the industry who is managing the public funds, have this concept of position sizing, exposure controls. So how does a retail investor should handle this position sizing, and how it can be of use to him, and how he can put, the exposure controls or the position sizing? You have been a practitioner of this. So can you take us through your experience of how you used to manage the portfolios with this concept of position sizing?
So I'll break this question into two, three parts. And let me explain, because as you mentioned, for most of the retail investors, this may not be the usual day-to-day language or day-to-day word which they use position sizing. It may be very obvious for many of us in this industry. See, Warren Buffett once very famously said about something called three C's, that if there is a crisis in the market and if you have cash in your pocket and if you deploy that cash by showing courage, which is the third C, you can make a lot of wealth. Now, this gives this illusion that the only way you can become wealthy is by waiting for the crisis and then having some cash to deploy and then showing courage to deploy. But this only be done by somebody like Warren Buffett or very few people. Because most of us, whenever there will be crisis, we may not be investing but redeeming money. Like we have seen, like you ask yourself a question, when there was a crisis in 2020 during COVID, whether you were investing or redeeming. Like many people say, during crisis, people redeem money. Actually, because people are redeeming money, that's why there is a crisis. The other way around, it is not that because market has fallen and hence out of panic people are redeeming. Because people are redeeming and hence there is a panic and hence markets are down. So how could you expect that if everybody else is redeeming, I will be investing and I will be having cash? Even if you follow this strategy of having cash and waiting for the crisis, you may not have the courage. And even if you have the courage, you have to wait for maybe 10 years because crises are very rare, which is the second point I just want to mention, that crises are very, very rare. Only once in 10 years, you see something happening, market going by 20, 30 or 30, 40%, which means market will test your patience because it is going down by 30, 40% only once in 10 years. In remaining 9 years, you will see your friends becoming wealthy, which means that waiting for the crisis, these fees, crisis, cash, courage, may not be a very practical strategy for most of the investors. So what can be the practical strategy? I have another three C's. I call them confusion, clarity, conviction. Let me repeat it once again. My three C's are confusion, clarity, conviction. That you have to invest during confusion, first of all. Okay, if you can invest during crisis, nothing like it. But the second best thing you can do is to invest during confusion. And confusions are not rare. Like even today, we have a lot of confusion. The benefit of heavy investing during confusion is that during confusion, you get very reasonable price or what you call valuation. The moment you wait for clarity, and if there is clarity, you cannot get the prices you are getting during confusion. So waiting for clarity to invest is a futile activity. You will get suboptimal return. You have to invest during confusion, knowingly that you don't know when will clarity will come. But you should have this conviction that there will be clarity and hence market will be back to its normal course. Now coming to this positional sizing, the fact that even let's say you have a 1 crore rupees portfolio, but you invest only 1 lakh rupees during 2020, during the crisis period. Like many people will say that, okay, you are saying that it is very difficult to invest during crisis, but I invested during 2020, during COVID period. But how much you have invested? Let's say your investable surplus was 1 crore rupees, but you invested only 1 lakh rupees. Now that 1 lakh rupees would have become 4 lakh or 5 lakh rupees by now, because from that point of time, market has risen in multiple times. But what benefit you can get out of that 4 lakh rupees gain? You cannot buy an XUV, because to buy an XUV, you need real money. You cannot buy an XUV with the help of CAGR. अब CAGR अभी कोई बोलता है that I invested during COVID, मेरा CAGR 30% है. आप 30% CAGR दिखा के कार के शोरूम में जाके कार नहीं खरीद सकते. You have to cut a check of 25 lakh rupees. And even if you are making only 15% or maybe 12% and not 20-30%, but you are making that 12% on a large size of corpus. Let's say you are making 15% return on 1 crore rupees corpus. In 5 years, it will become 2 crore rupees approximately. Okay, तो double हो जाता है. तो 1 crore रुपए बनाना important है. We are here to make wealth. We are not here to make CAGR. CAGR will give you bragging right. When everybody was redeeming money, मैंने invest किया, मेरा CAGR 30% है. But उसके आपका financial goal पूरे नहीं होते. तो sizing मतलब that you have to invest substantial amount of money. Even if you are making average return, you will make wealth. But if you are making very small amount of your surplus money, and even if you are making very high CAGR return, you cannot make wealth. You can only make CAGR return on that particular small amount. तो अपने को sizing करनी है, and sizing cannot be done at the time of clarity. क्योंकि clarity जब आती है ना, वहां से return suboptimal बनते हैं. And sizing हो नहीं पाती एट द टाइम ऑफ क्राइसिस, क्योंकि क्राइसिस में हमें वो कॉन्फिडेंस नहीं आता. तो कंफ्यूजन में साइजिंग करनी चाहिए और साइजिंग से ही वेल्थ बनती है. द ओनली पर्पस वी आर इन्वेस्टिंग इज टू क्रिएट वेल्थ एंड नॉट टू क्रिएट CAGR.
Manoj, I learned something new today because this was a fine articulation you gave, the position sizing during the confusion period. Probably we'll implement this in our discussions with our clients. Something I really, really learned. One of the happy moments of this producing videos is that when we talk to experts like you, we get these ideas many a times which can be practically implemented. Thank you for this. One final question. I know you were running out of the time. How can an investor build a durable portfolio to withstand all kinds of an eventuality in the market? Good times, bad times. He should not come with excessive money when everybody is gung ho about the market, or he should not find to the exits if the markets were to be not there. Is there a method by which somebody can build a durable portfolio? What does your experience say about it?
So yes, there is a framework, and it is a very practical framework. Let me break down this answer into two, three parts. First of all, as an investor, let me give you high level comment that as an investor, we must use time, diversification, and discipline to our advantage. These three things. Let me repeat it once again because this is very important. We must use time, diversification, and discipline to our advantage when investing in a volatile asset class like equity. Second, we must follow asset allocation, which means that we cannot be 100% sure at any point of time that a certain theme will do exceptionally well. Just say, let me give you an example. Think of this like playing a game of poker. Now, a skilled player never bet their entire pile on one particular hand, even if it looks too good, because no hand is a guarantee win. There will still be a probability that you can still lose. Obviously, if you are putting everything, that means you have a very high probability, maybe 90, 95, 99% probability that you are going to win. And that's why you are ready to put everything on that particular hand. But there is still 1% probability that things may not go the way you want it to be, which means if you lose now, everything will be lost and you will be out of the game. And now there is no recovery. Hence, our strategy should be such that even if we are 100% sure on something, maybe on the positive side or the negative side, we should use diversification, asset allocation to our advantage so that we can be in the game. First of all, you have to be in the game so that you may win it. Like in टेस्ट मैच आपको फिफ्थ डे तक रहना पड़ता है ना, फिर उसके बाद डिसाइड होता है फिफ्थ डे पे, मे बी फोर्थ सेशन पे डिसाइड होता है कि आप जीतोगे या हारोगे, डिपेंडिंग ऑन हाउ यू परफॉर्म. सो यू हैव टू बी इन द गेम, एंड गेम में रहने के लिए आपको एसेट लोकेशन बहुत जरूरी है, सो दैट यू डोंट थिंक इमोशनली, आपके इमोशन ट्रिगर ना हो जाए एक्सट्रीम मार्केट सिचुएशंस में. उसके लिए बड़ा प्रैक्टिकल चीजें क्या है, एसेट लोकेशन को फॉलो कैसे किया जाए. Like Chandrakanta sir, you also said, I'm now addressing to all the audience, like sir has mentioned, थोड़ी कम वैल्यूएशन पे, यदि कि मार्केट जब सस्ती होती है, when markets are undervalued, you can invest slightly more in equity, and when markets are slightly expensive, you can take it out money. Now, how can we do it in a most tax efficient manner, in a practical way? So there are two kinds of needs, money needs. One is discretionary need, and second is absolutely mandatory need. For example, अगर आपको मेडिकल कोई इमरजेंसी आती है घर में, और दिस इज अ मैंडेटरी नीड, आपको पैसा निकालना ही पड़ेगा, आप वैल्यूएशन नहीं देखोगे, यू विल नॉट सी वेदर मार्केट्स आर चीप और एक्सपेंसिव. इट इज, इफ इट इज अ मेडिकल इमरजेंसी, you will withdraw money. But let's say you want to upgrade your car. Now this is not a mandatory need. This is basically discretionary consumption. And market valuations are very cheap. Let's say we are sitting in June 2020 or July 2020 and you want to upgrade your car. I think you should postpone your discretionary consumption because markets are very, very cheap. So it is better to stay invested for another couple of months or maybe couple of quarters. And then if market revive, then buy SUV maybe at a later stage. Likewise, if you want to upgrade your SUV, your car to an SUV after, let's say, 6 months, but market have risen so much that now they are slightly overvalued on various parameters, then you can prepone your discretionary consumption. So these are the way you can cut down your equity allocation at a higher valuation by preponing your discretionary consumption, and by postponing your discretionary consumption during a relatively cheaper market or undervalued market, you can again stay invested and make most of your money. So asset allocation is important because it can help you to avoid emotional outburst. During extreme situation, we tend to take wrong decision. We cannot be 100% sure at any point of time, which means we cannot operate with all or nothing strategy. If you give time and if you are disciplined enough, let me give you the last example. Let's say you invested during September 2024, about 11 months back when markets were at peak. Right now, markets are slightly on the lower end. Even if you invest during peak, if one single additional purchase can solve most of your problem. That even if you enter at the market at the very peak, if one additional purchase at a lower level can bring down your average cost to a large extent, and a small recovery will make your portfolio in positive territory. So always invest regularly. If you invest regularly, no matter how small amount, even if you enter at the very wrong time means you enter at the peak, this regular investment will ensure that you can still make a very reasonable return over the long time.
Dear viewers, our channel grows because of your subscription. Many of you watch our videos, forget to subscribe to the channel. Please hit that subscribe button right now and press the bell icon. We give you 2 videos every week. Every Tuesday, an expert comes on the channel and talks about the subject matter on which he is an expert on. Every Friday, I speak my mind out on the topic your life, your money. Each one of these videos are filled with value. Don't miss any one of them. Do subscribe right now. By the way, if this conversation was very useful to you, it gave you an idea how you can build durable portfolios, do not forget to like these videos. Do share these videos with your near and dear ones, friends and relatives, and on all the social media handles on which you are connected with. Manoj, it's a phenomenal conversation. And to distill that practical knowledge in a manner that the audience understands is something which I enjoyed talking to you a lot. I keep calling to you once in a while to share your practical insights. Thank you very much for your kindness, your time in sharing all these things. Thank you very much, Manoj.
Thank you, Jaggaji.
Dear viewers, I'll be back with you next Tuesday with yet another expert, with yet another topic. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.